In 1929, Joseph Kennedy made 3 specific trades just 6 months before the Great Crash. He moved to cash, bought gold, and bet on volatility. The market then plummeted 89%. While fortunes evaporated overnight, Kennedy walked away with what would be $50 million today. Fast forward to 1987. Paul Tudor Jones made the same 3 trades. On October 19th, the market crashed 22.6% in a single day. Jones made $100 million before lunch. Then came 2008. Michael Burry, John Paulson, they made billions in profit while banks collapsed and millions of people lost their homes. Now, look at today. Warren Buffett is sitting on a record $325 billion in cash. Ray Dalio is loading up on gold. Bill Ackman is buying volatility protection. Here's what should concern you. They're not just guessing. They are following a playbook that has worked for a century. In this video, I'm going to show you the mechanical pattern that appears before every single major crash. By the end, you'll understand exactly where we are in this cycle, and more importantly, what you can do about it before it's too late. Because make no mistake, the 3 trades have already been made. The pattern is repeating, and the next crash is on its way. Let me ask you something. Why these 3 trades? Why not 2? Why not 10? It's because crashes don't happen randomly. They follow a sequence as predictable as dominoes falling. It all starts with phase 1, recognition. This is when the smart money realizes that asset prices have completely disconnected from reality. They quietly exit their positions before everyone else figures out what's happening. Then comes phase 2, preservation. Just sitting in cash isn't enough. Currencies devalue and inflation eats away at your purchasing power. You need a real anchor, something that holds its value. For 5,000 years, that anchor has been gold. Finally, phase 3, profit. This is where fortunes are truly made. While everyone else is panicking and selling, you are perfectly positioned to profit from the chaos itself. Execute all 3 of these phases correctly, and a 4th trade opens up for you. That's the opportunity to buy high-quality assets at a 50% discount when fear is at its absolute maximum. This is how generational wealth is created. Now, let me take you inside each of these trades and show you exactly how they have played out across history for nearly a century. Let's go back to the summer of 1929. Joseph Kennedy controls massive stock positions. The market is euphoric. Stocks have tripled in just 5 years. Margin debt is at record highs. People are borrowing 90 cents for every dollar just to buy more stocks. But Kennedy sees something that almost nobody else does. He understands that when everyone is leveraged to the maximum, there's nobody left to buy. And without new buyers, the music has to stop. He starts quietly converting his stocks to cash. He doesn't do it all at once. That would crash his own positions. He does it methodically over several weeks. By September, Kennedy is completely out of the market. On September 3rd, the Dow Jones Industrial Average peaks at 381. The stage is set. Now, the preservation trade. Kennedy understood that the US dollar was still tied to gold, but the system was under immense strain. A banking crisis was almost inevitable. So he didn't just hold cash, he held gold. It was the ultimate safe haven, an insurance policy against the entire financial system imploding. And then came the 3rd trade, volatility. This is the masterstroke. It's not just about getting out of the way of the crash, it's about making money from the crash itself. While the exact instruments were different back then, the principle was the same. He was betting on chaos, on fear. He shorted stocks, which is essentially a bet that their prices will go down. On October 24th, Black Thursday, the panic begins. The market drops 11%. Bankers try to prop it up, but it's like trying to stop a tsunami with a bucket. The following week, on Black Monday and Black Tuesday, the market completely collapses. It drops another 23%. In 2 days, the market loses the equivalent of trillions of dollars in today's money. While the public was ruined, Joseph Kennedy's shorts were printing money. His cash and gold were safe. He not only survived, he thrived. The crisis made him one of the wealthiest men in America. He had followed the 3-trade playbook to perfection. This wasn't a one-off event. Let's jump to 1987. Paul Tudor Jones, a young hedge fund manager, saw the exact same pattern forming. The market had been on an incredible bull run, but valuations were stretched to their breaking point. He saw the same euphoria, the same leverage that Kennedy saw. Jones started building his positions. He went heavy into cash. He bought gold. And most importantly, he bought a massive amount of put options on the S&P 500. These are instruments that explode in value when the market crashes. He was betting on volatility. On October 19th, 1987, known as Black Monday, the Dow Jones dropped 22.6% in a single day, the largest one-day percentage drop in history. Paul Tudor Jones's firm made an estimated $100 million loss. His partners thought their systems were broken because the profits were so immense. Once again, the 3-trade playbook worked. So where are we now? The pattern is repeating, but on a scale that's bigger than ever before. We see the smart money moving. We see the record cash piles. We see the central banks buying gold at an unprecedented rate. The volatility trades are being placed. You need to understand this sequence: recognition, preservation, and profit. This isn't about fear. It's about preparation. It's about understanding the game that's being played at the highest levels. In my next video, we'll break down the specific indicators that are flashing red right now and discuss the concrete steps you can take to implement this strategy yourself. Let's talk about Black Thursday, October 24th, 1929. Just 7 weeks after legendary speculator Joe Kennedy sold all his stocks, the market began its death spiral. By the time the dust settled, the Dow had crashed a staggering 89%. But Kennedy, he was safe, sitting on a mountain of cash, protected and ready to buy at the bottom. Fast forward to 1987. Paul Tudor Jones, a brilliant hedge fund manager, was getting nervous. The market had rocketed up 140% in just 5 years. Valuations were stretched thin, and margin debt was through the roof. Jones didn't just cross his fingers and hope for the best. He sent out explicit memos to his investors, warning them to expect a major crash by October. Throughout September, he raised cash. On October 2nd, the market hit its peak. Just 17 days later, on October 19th, Black Monday arrived. The Dow plummeted 508 points, the largest single-day percentage drop in history. But Paul Tudor Jones and his investors were already positioned. They were protected. Then came 2008. The signs were there for those willing to see. Michael Burry, famously portrayed in The Big Short, started raising cash way back in 2005. His deep dive into subprime mortgages revealed a financial system rotting from the inside out. He stopped buying stocks completely. Around the same time, in 2006, John Paulson reached the same terrifying conclusion. The housing bubble was a ticking time bomb set to obliterate the banks. He launched a fund specifically to bet against it. And what about Warren Buffett, the most conservative investor of them all? By 2007, his company Berkshire Hathaway's cash position had swelled from $40 billion to over $60 billion. When reporters asked him why, his answer was simple and profound. He couldn't find anything worth buying at the current prices. In October 2007, the market peaked. All three of them, Burry, Paulson, and Buffett, were already in defensive positions. Then the dominoes began to fall. Bear Stearns, Lehman Brothers, AIG, the entire global financial system teetered on the brink of collapse. But these three investors, they were protected. Now, let's look at today. What is Warren Buffett doing? He isn't just holding some cash. As of early 2025, Berkshire Hathaway is sitting on an unprecedented $325 billion. This is the largest corporate cash pile in history, both in absolute dollars and as a percentage of Berkshire's total assets. He's been systematically selling off his holdings. He slashed his Apple position by 50%. He's been dumping shares of Bank of America every single month. His 2024 letter to shareholders was crystal clear, stating he cannot find anything attractively priced. This isn't just an observation. It's a direct warning from the most successful investor of our time. And he's not alone. The smart money is heading for the exits. Jeff Bezos has sold over $13 billion of his Amazon stock. Mark Zuckerberg has been selling billions in Meta shares, even as the stock was hitting all-time highs. Jamie Dimon, the CEO of JP Morgan Chase, sold his company's stock for the very first time in his tenure. Insider selling across corporate America is now at levels we haven't seen since just before the 2008 crash. These are the people who run the companies. They see the real, unvarnished numbers, and their actions speak louder than words. They are running for safety. The first trade of the insiders is complete. They are out. This is where it gets truly interesting for us. Having cash provides safety, but it's not the full picture. Let's go back to 1929 again. Bernard Baruch was one of the most successful speculators of his time. A man who had made fortunes in previous panics by spotting bubbles early. Like Kennedy, he saw the crash of 29 coming and moved to cash, protecting his wealth. But Baruch knew that surviving the crash was only half the battle. Did you know that central banks around the world are on a buying spree? China is buying, Russia is buying, India, Turkey, Poland, Singapore. They're all accumulating massive amounts of gold. They see what's coming, unsustainable U.S. debt and the inevitable devaluation of currencies. Gold is their lifeboat, and it's not just governments. The world's smartest investors are sounding the alarm. Ray Dalio, the founder of the largest hedge fund in the world, recommends holding 5 to 10% of your portfolio in gold. Legendary investor Stanley Druckenmiller has disclosed major gold positions, and Paul Tudor Jones owns gold as a hedge against what he calls the great monetary inflation. They understand that gold is real money, a store of value that has survived every financial crisis in history. This is trade number 1. The survival trade. It's about preserving your wealth when everything else is falling apart. Now let's talk about trade number 2, the insurance trade. Right now gold is hitting record highs. Why? Because the smart money knows what happens next. When the next financial crash hits, and it will, the Federal Reserve will have only one response: print money. Not just billions, but trillions. Unlimited quantitative easing to try and prop up the system. When that happens, the value of the dollar will plummet, and the price of gold will skyrocket. We're not talking about small gains. We're talking about gold going to $5,000, $6,000, maybe even $10,000 an ounce. This isn't speculation. It's a predictable response to a monetary crisis. Owning gold isn't just about survival. It's about insuring your portfolio against the massive inflation that's on the horizon. But there's a third trade. This is the one that separates the wealthy from the ultra-wealthy. This is the profit trade, the one designed not just to survive a crash, but to make a generational fortune from it. Let's look at history. Think about 1929. The Roaring Twenties were in full swing, and everyone thought the party would last forever. But Joseph P. Kennedy, patriarch of the famous Kennedy family, saw the writing on the wall. In the late summer, he began establishing massive short positions. He borrowed shares of stocks and sold them at their peak prices. Then he waited. When Black Tuesday hit and the market crashed, stocks fell over 30% in just a few days. Kennedy then bought back those same shares at their collapsed prices, returned them to the lenders, and pocketed the difference. Conservative estimates put his profit between $15 and $50 million, hundreds of millions in today's money. That is the power of the third trade. Let's fast forward to 1987. Another legendary investor, Paul Tudor Jones, pulled off one of the greatest trades in history. In a stroke of incredible timing, a documentary crew was actually filming him as it all went down. Jones was convinced a crash was imminent, so he bought massive amounts of put options on stock index futures. A put option gives you the right, but not the obligation, to sell an asset at a predetermined price. If the market crashes below your strike price, you profit from every single point it falls. Jones bought thousands of these contracts, paying millions in premiums. He placed his bet and waited. On October 19th, 1987, known as Black Monday, the market crashed an astonishing 22.6% in a single day. As panic swept Wall Street, Jones' put options exploded in value. He personally made an estimated $100 million that day. His fund was up 62% in October alone, while everyone else was losing their shirts. These stories aren't just fascinating tales from the past. They are blueprints. They show that the biggest opportunities for wealth creation don't happen when markets are calm and rising. They happen during times of maximum fear and chaos. The same patterns are repeating right now. The debt is bigger, the bubble is more fragile, and the tools for profiting from the downside are more accessible than ever before. While most people will be wiped out by the coming crash, a select few will use it to create life-changing wealth. The question is, which side of history will you be on? Will you be part of the crowd that gets crushed? Or will you be one of the few who see the opportunity and seize it? You've probably seen the movie, but have you seen the actual documentary footage? There's this clip of a trader on the phone executing deals. You can literally watch him making millions of dollars in real time. It is probably the most perfect execution of a legendary trade ever recorded on camera. That trade, it's what many now call the greatest trade of all time. Let's go back to 2008. The man at the center of it all was Michael Burry. He saw the writing on the wall for the housing market, but there was a problem. He couldn't directly bet against subprime mortgages. The financial tools simply didn't exist. So what did he do? He invented them. Burry went to big banks like Goldman Sachs and convinced them to create a brand new instrument called a credit default swap. Think of it like an insurance policy. He was insuring mortgage bonds against failure. Here's how it worked. Burry would pay an annual premium, say between 2 and 4%. If he insured $100 million worth of bonds, he'd pay $2 to $4 million each year. If the housing market stayed strong and the bonds never failed, he would lose all that premium money. But if the bonds defaulted, he would collect the full $100 million. From 2005 all the way to 2007, Burry just kept paying those premiums. Month after month, year after year, he was bleeding cash. His own investors were furious. They were trying to pull their money out, sending him angry emails, thinking he had completely lost his mind. After all, the housing market was still booming. On paper, he was just throwing millions of dollars into a fire. But Burry wasn't just guessing. He had done the math. He understood the toxic combination of bad loans and complex derivatives better than anyone. He knew it was just a matter of time. And then 2008 happened. The dominoes started to fall. Those mortgage bonds, the ones everyone thought were rock solid, began to default in massive numbers. Suddenly, Burry's insurance policies, his credit default swaps, became incredibly valuable. The contracts he had bought for just a few $1,000,000 started paying out hundreds of millions. In the end, his fund, Scion Capital, made over $700 million in profit. Burry himself walked away with a personal profit of $100 million. But Burry wasn't the only one. A hedge fund manager named John Paulson saw the same opportunity and executed the same trade, but on an absolutely colossal scale. We're talking tens of billions of dollars in credit default swaps. When the housing market finally collapsed, Paulson's firm collected an astonishing $15 billion in payouts. His personal take from that single trade was $4 billion. To this day, it remains the biggest, most profitable hedge fund payout in history. Now, fast forward to today, to 2025. What if I told you that the third iteration of this legendary trade is active right now? 3 key instruments are flashing bright red, signaling that a massive opportunity is on the horizon. The first signal is in the credit default swaps themselves, but this time, they're not on residential mortgages, they're on commercial real estate. Since 2021, the cost of these swaps has skyrocketed, jumping by 300 to 500%. That's the market telling us that the risk of default is incredibly high. The second signal is vacancy rates. Just look around any major city. Office buildings are eerily empty, with vacancy rates hitting 40 to 50% in some areas. The pandemic triggered a permanent shift to remote and hybrid work, and companies are realizing they just don't need all that expensive office space anymore. This isn't a temporary dip, it's a fundamental change in how we work. The third and most crucial signal is interest rates. Many of these commercial properties were financed years ago with mortgages at low rates, around 3%. But those loans are now coming due, and they have to be refinanced at today's rates, which are hovering around 8% or even higher. The math simply doesn't work. The income from these half-empty buildings can't possibly cover the new, much higher mortgage payments. Widespread defaults are no longer a possibility. They are an inevitability. When these defaults begin to cascade, those credit default swaps on commercial real estate will pay out massively, just like they did in 2008. The stage is set for what could be the next great trade. History doesn't always repeat itself, but it often rhymes. And right now, the rhythm sounds awfully familiar. Have you seen what the smartest money in the world is doing right now? Take a look at the options market for major indices like the S&P 500. We're seeing massive, unusual purchases of put options, expiring late 2025 and even into 2026. The put-to-call ratio is way above 1, meaning far more people are betting on a decline than a rise. Now, these aren't small-time speculators. These are institutions, and they're not gambling. They're hedging. They're buying insurance against a major market downturn, and that's not all. They're also quietly accumulating call options on the VIX. The VIX, or the volatility index, is often called the fear gauge. Normally it sits around 15 or 20, but during a crash, it spikes to 50, 60, even 70. Buying VIX calls is a direct bet on chaos. It's a trade that only pays off when panic hits the market. Even billionaire investor Bill Ackman has publicly mentioned he's considering hedges similar to the one he made back in March 2020. You might remember that one. He turned a mere $27 million into $2.6 billion in just a few weeks by betting against corporate credit. When the smartest money in the world starts making these kinds of moves, long-dated puts, VIX calls, and credit protection, you have to pay attention. They're executing these trades in real time right now. To understand why they're doing this, you need to understand that every market crash follows the exact same sequence. It unfolds in 6 stages, like clockwork. Stage 1 is the bubble. This is when asset prices completely disconnect from their underlying value. A great way to measure this is the Buffett indicator, which compares the total stock market valuation to the country's GDP. Right now, it's at 185%. That means the stock market is valued at nearly twice the entire economic output of the United States. We've only seen levels this high twice before. Once in 2000, right before the dot-com bust, and again in 2007, just before the global financial crisis. Both times, the market crashed within months. Stage 2 is euphoria. This is the psychological component. Everyone starts to believe that prices will just keep going up forever. The popular narrative of 2025, it's all about AI. AI will change everything, they say. Valuations don't matter, just buy the dip. This is classic late-stage bubble thinking. Stage 3 is maximum leverage. When prices are rising, borrowing money to buy more assets amplifies your gains. So naturally, everyone starts doing it. Right now, margin debt is near record highs. You see leverage everywhere, from corporate balance sheets to individual trading accounts. Stage 4 is the trigger. This is the event that pops the bubble. It could be anything. A wave of commercial real estate defaults, a major bank failure, a sudden geopolitical crisis. Honestly, the specific trigger doesn't even matter that much. What matters is what comes next. Stage 5 is forced liquidation. All those leveraged investors suddenly face losses. They get margin calls from their brokers, demanding more cash. To raise that cash, they are forced to sell their assets. This selling pressure drives prices even lower, which triggers more margin calls, leading to more forced selling. It's a vicious death spiral, a liquidation cascade. This is why crashes happen so fast. It's not a gradual decline, it's a cliff. Stage 6 is panic. Fear completely takes over. Everyone tries to sell everything at once, but there are no buyers. Liquidity vanishes. Bids disappear. Prices gap down violently. This is when the VIX spikes, and markets can fall 30 or 40% in just a few weeks. And this is precisely when those 3 trades we talked about pay off massively. The smart money isn't just protecting itself, it's positioning to profit from the chaos. So where are we in this cycle right now? Let's look at the evidence. The first move, getting out of the market, is largely complete. Think about Warren Buffett sitting on over $300 billion in cash and short-term treasuries. Insiders are selling their own company stock at a rate not seen since 2007. The smart money has already exited. The second move, wealth preservation, is accelerating. In the last 3 years, central banks have bought over 3,000 tons of gold. Gold is hitting record highs, not because of inflation, but because it's the ultimate safe haven asset in a crisis. And the third move, betting on volatility, is being established as we speak. We're seeing the institutional put buying and VIX call accumulation I mentioned earlier. This is the final piece of the puzzle being put into place based on historical patterns and the timing of these institutional trades. It looks like we are about 12 to 18 months away from the main event. That puts the window for a potential crash somewhere between late 2025 and early 2026. When it hits, during this chaos, the 3 trades pay off. Then comes the fourth and final move, using your preserved capital and trading profits to buy high-quality assets at fire sale prices. This is how generational wealth is truly made. Now, most people can't perfectly replicate what these institutions are doing. You don't have hundreds of millions of dollars or access to complex derivatives, but you can execute simplified versions of this strategy to protect yourself and even profit. Here are the 3 trades that the world's smartest investors are making right now to prepare for the biggest crash of our lifetime. And a fourth trade that could make you a fortune. First, they're raising cash. If your portfolio is 70% in stocks, they're suggesting you reduce it to 40% or 50%. The cash you raise isn't just sitting there, it's going into safe havens like treasury bills or money market funds. Why? Because when the crash hits, that 30% of your portfolio is protected. It's not just safe, it's your buying power, your dry powder, ready to be deployed when assets go on a fire sale. Second, they're buying gold. I'm talking about a 5 to 10% allocation to physical gold or gold ETFs, not volatile mining stocks. Think about it. When the financial system is on the brink and the Federal Reserve starts printing trillions of dollars to bail everyone out, what happens to the value of cash? It plummets. But gold? Gold is the ultimate store of value. It has been for thousands of years. It's your hedge against currency debasement, preserving your purchasing power when paper money becomes worthless. Third, they're buying protection. This is like buying insurance for your portfolio. They're purchasing put options on the S&P 500 ETF, symbol SPY. These aren't short-term gambles. They're set to expire in 6 to 12 months, with strike prices 10 to 20% below where the market is today. Yes, it costs money, maybe 1 to 3% of your portfolio value. If the market doesn't crash, you lose that premium. But if it does, those options could explode in value, returning 5, 10, or even 20 times your investment. It's about profiting from the chaos. But here's the most crucial part, more important than any trade. It's your psychology. Imagine it. Markets are down 40%. Every news channel is screaming about the end of capitalism. Unemployment is soaring, banks are failing, and your friends and family are panicking. This is the moment of maximum fear, and this is the moment you have to be ready to act. This is where the fourth trade comes in. You buy. You have a list prepared in advance, a list of world-class companies with strong balance sheets, low debt, and essential products. Think Apple, Microsoft, Visa, Johnson & Johnson. When these giants are trading at a 50% discount, you deploy everything. The cash you protected, the purchasing power you preserved with gold, the massive profits you just made from your put options. You buy aggressively while everyone else is frozen in fear. This isn't a secret. This pattern has repeated itself for a century. 1929, 1987, 2008. The playbook was the same. Raise cash, buy gold, buy protection. It worked then. The smartest minds are betting it will work again. We're seeing it happen in real time. Warren Buffett is sitting on over $300 billion in cash and equivalents. Central banks are buying gold at a record pace. Hedge funds are quietly loading up on protection. The timeline, we could be looking at 12 to 18 months from now, late 2025, maybe early 2026. When the trigger hits, the fall will be fast. Most people will be caught off guard. They'll say, this time is different, and they'll lose half their portfolio. But a small few will see the pattern, execute the plan, and turn the greatest crisis into their greatest opportunity. The choice is yours. This isn't financial advice, it's pattern recognition. The trades must be made before the panic starts, because once it's happening, it's already too late. If this video opened your eyes, subscribe to the channel. Over the next 12 months, I'll be tracking all the signals so you'll know exactly when it's time to act. Let me know in the comments. Are you preparing? Which of these trades makes the most sense for you? Thanks for watching.